Good afternoon, friends. Today we will discuss Unit 10 of Financial Management, that is Capital Structure Decision. At first, let me tell you what is the learning objective of today's session. Our learning objective is first we will understand what is capital structure. Then we will discuss appropriate capital structure. Next, we will discuss what are the factors that have a bearing on determining the capital structure. So, what is our scheme of discussion in today's class? First, we will discuss give a brief introduction on capital structure. Next, we will discuss concept of capital structure. Next, we will discuss different features of appropriate capital structure. Next, we will discuss determinants of capital structure. Next, we will summarize our discussion. We will discuss some keywords and some assessment questions. Friends, business need finance. Finance is required for business for two purposes. First purpose is for establishing the business, and the second purpose is for running the business. The capital required for establishing the business is required for long-term purpose, and the capital required for running the business is required for a short period of time. Hence, the funds requirement of an organization may be divided into two parts: long-term funds and short-term funds. Friends, the short-term funds usually fluctuate a lot. It means short-term funds requirement differs from period to period. In our previous class discussion, short-term funds are required for working capital financing. We have discussed that working capital requirement of an organization differs in period to period. Hence, short-term funds usually fluctuate over period. Hence, while deciding the capital structure, we focus our discussion only on long-term funds. So, the composition of long-term funds in an organization is referred to as capital structure. So, what is capital structure? Capital structure is the composition, is the combination of long-term funds in a business. Generally, long-term funds are used for financing fixed assets. So, the composition or combination of long-term funds is known as capital structure. A business gets long-term funds from two ways. First is borrowed fund, that is known as debt. Another is own fund, that is known as equity. Hence, a firm may use debt capital or equity capital, or a firm may make a combination of both debt and equity capital. And this combination of debt and equity capital is known as its debt equity mix or its capital structure. Hence, capital structure decides the debt equity mix or debt equity ratio of an organization. So, what is capital structure? Capital structure we have already discussed. It's the combination of debt and equity. It's the mix of debt and equity. It's the mixture of own capital and loan capital. In a business, how much own capital we will use and how much loan capital we will use, or we will use totally own capital or totally loan capital, or a mixture of both. That decision is discussed under capital structure. Hence, the mix or proportion of different type of finance, that is debt and equity, is known as capital structure. So, what is capital? Why to plan capital structure? We know that we should plan for capital structure because always our motive is to get capital at lowest cost. The cost capital must be obtained in such a way that the cost of capital will be minimum. That capital structure where cost of capital is minimum is known as optimum capital structure or best capital structure. Hence, capital structure planning focuses on deciding the optimum capital structure or best capital structure of an organism. So while deciding the best capital structure or appropriate capital structure of an organization or sound capital structure of an organization, we have to focus, we have to consider certain factors. Those factors can be classified into three parts. What are the three parts? What are the three considerations we decide while deciding the best capital structure? First one is profitability. Next one is solvency. Next one is flexibility. So we will discuss it one after one another. What is profitability? A capital structure should be designed in such a way that the cost of capital will be lowest. You know that there are two types of capital. One is debt capital, another is equity capital. In cost of capital chapter, we know that usually cost of debt is less than cost of equity. Hence, a business use more and more debt capital, and use of debt capital creates financial leverage in the business. So in appropriate capital structure or sound capital structure, we have to decide the appropriate level of financial leverage. A company should use that level of financial leverage where the cost of capital is minimum. Hence, while deciding capital structure, the first important consideration a organization take is known as the profitability of the business. Next important point which the organization considers while deciding capital structure is solvency of the business. What is solvency? If a company use more and more debt capital, its financial risk increases. The burden to pay interest and repay back the capital in due time increases. And this poses a threat on the solvency position of the business. Hence, a company should not use excessive debt capital. Debt capital, though is low cost, one should not use excessive debt capital in the capital structure. If a company use excessive debt capital in the capital structure, then its solvency position will be affected. Hence, we have to decide this solvency position while deciding the capital structure. Next factor which one consider while deciding the capital structure is flexibility. What is flexibility? The capital structure should be designed in such a way that we can increase or decrease the supply of finance whenever is needed. So it must be flexible in nature. It must be designed in such a way that we can expand it or we can contrast it when, as and when situation requires. So three things we have to consider. One is profitability, another is solvency, another is flexibility while designing the capital structure of an organization. Next, we will discuss what are the main features or determinants of capital structure of an organization. We know that there are many factors which are to be considered by the company while deciding the capital structure of an organization. We will discuss those factors one by one. The most important factor which a company consider while designing the capital structure, that is known as leverage or trading on equity. We know that there are two types of capital. One is ownership capital, which is known as equity capital or equity. Another is creditorship capital or borrowed capital, which is known as debt. We know that cost of debt is less than cost of equity, or symbolically we know KD is less than KE. What is KD? Cost of debt is less than cost of equity. But how much debt a company should use, how much equity a company should use, that decision is known as capital structure decision. Once you use more and more debt capital, we know cost of debt is less. Suppose you take a loan of 100 crores in a business and you take the loan at 10%. So cost of debt is 10%. Let's assume cost of debt is 10%, and you invest this 100 crores in the business and you generate a return of 14%. So what is the excess return? Your return on investment is 14%, but your cost of capital is 10%. So what is the excess return? Excess return you get is 4%. And this 4% is taken by who? This 4% is taken by the equity shareholder, because debt holders have already taken back their money. So this 4% is taken by equity shareholders. And you use low cost debt capital to magnify the return of equity capital. This sort of magnification is known as trading on equity. So what is trading on equity? Trading on equity is a concept where a company use low cost debt capital or low cost preference capital to magnify the return of the equity shareholders. This is known as trading on equity. So it is also called financial leverage. So in case of financial leverage or trading on equity, what we do, we use fixed cost source of finance. What is fixed cost source of finance? There are two fixed cost source of finance. One is debt, another is preference share. So we use debt and preference share to magnify the return of equity shareholders. So cost of debt is KD, cost of preference share is KP. We know that both KD is less than KP is less than K. The cost of debt as well as preference share is less than cost of equity. Hence, if we use debt capital or preference share capital and generate a return more than the cost of debt capital and preference share capital, the rest will go to equity shareholders. And this concept is known as trading on equity. So financial leverage or trading on equity is the use of fixed cost source of finance such as debt and preference to fund assets of a company. And if the return on debt finance assets exceeds the cost of debt, then earning per share will rise without increase in owner's investment. And this concept is known as trading on equity. Trading on equity works both if you use preference share or if you use equity share or you use debt capital. In case of debt, trading on equity arises. In case of preference, trading on equity arises. But the leverage effect or trading on equity effect is felt more in case of debt capital because of two things. First thing is cost of debt is typically lower than cost of preference share. We have discussed KD is lower than KP. Hence, the magnifying effect is much more created if you use debt capital. And the second point is interest paid on debt capital is a tax deductible expenses. What does it mean? It means when you pay interest on debt capital, interest is an expenses. It is put in profit and loss debit side. It reduces the taxable profit of the business, and if it reduces taxable profit, it reduces the tax burden of the company. By paying interest on debt, you save some tax, and this tax concept is known as tax shield. So because of two things, KD is less than KP and you get the benefit of tax shield while you use debt capital. The trading on equity operates more or better when you use more and more debt capital in your capital structure. Now next question arises, how much debt capital we must use? Because we know if we go on increasing debt capital in our capital structure, what will happen? The cost of debt will be less than cost of equity, but the financing risk of the business or financial risk of the business or the solvency position of the business may be at stake. So one should not use maximum debt capital. One should use debt capital up to a particular limit, and that limit is known as optimum level of debt capital. So how to decide the optimum level of debt capital for this, and how to decide which capital structure is best for a organization? For this we do one analysis. That analysis is known as EBIT EPS analysis. So now we will discuss on EBIT EPS analysis. What is EBIT EPS analysis? In this case, the EBIT in different capital structure will be known, and you have to calculate EPS in different capital structure. What is EBIT? EBIT means earning before interest and tax. And what is EPS? EPS means earning per share. If you analyze the income statement of an organization, it will be like this. Income statement. We know how income statement of an organization looks. First we have net sales. Out of net sales, if we less COGS, cost of goods sold, we generally get gross profit. And out of gross profit, if we less operating expenses, we get operating profit. And this operating profit is also known as EBIT. Operating profit or EBIT. What is EBIT? Earning before interest and tax. This is the earning, this is the profit generated before you pay interest and tax. Out of this, first you pay interest. Once you pay interest, the thing which remains is earning before tax. Once you pay earning before tax, then you less tax. You get earning after tax or profit after tax, which is known as net profit. You get net profit. Net profit. Once you have net profit, what you do? You less preference dividend. And you get earning for equity shares. And if you divide earning for equity shares with number of equity shares, you get number of equity shares. Earning of equity shares is A and number of equity shares is B. If you divide A by B, you will get earning per share. What is earning per share? How earning per share is decided? It is divided by A divided by B. What is A? A is equal to earning available for equity share divided by number of equity share. Earning for equity divided by number of equity. Whatever you get, that is known as EPS, earning per share. That is EPS. So what we will do, in case of EBIT EPS analysis, we will compare EBIT with EPS. We will find out EBIT in different capital structure and we will find out EPS in different capital structure, and that capital structure where EPS is maximum, we will select that capital structure. And this type of analysis is known as EBIT EPS analysis. So let's take an example and we will solve this example to find out, make EBIT EPS analysis. We will solve illustration number 10.1. Suppose a company has three plans, plan A, plan B, plan C, for designing its capital structure. First plan tells that the company will use no debt. It will use all equity shares. And the total capital required for the company is 2 lakhs. So it is given in plan A, the company will use all equity shares and the total capital required for the company is 2 lakh. Next, in the question it is given the face value of equity share is 10. So what is the first plan? The first plan that company will use only equity share and the equity shares are of 10 rupees worth each and total amount required for the company is 2 lakhs. If the total amount required for the company is 2 lakh, per share face value is 10, how much equity share company has to issue? Company has to issue 20,000 equity shares at the rate of 10 per shares. This is the first capital structure of the company, first plan of the company. What is the plan B? Plan B, the company will use 50% debt. So 50% debt means how much debt? 1 lakh rupees debt. 1 lakh debt plus. What is the second plan? It will use 30% preference share. 30% means total requirement is 2 lakh. 30%. 30% means 60,000. 60,000 rupees preference share. And what else it will use? 1 lakh plus 1 lakh debt plus 60,000 preference share plus it will use 20% equity. 2 lakh 20% 40,000. 40,000 equity. 40,000 equity face value is rupees 10. So it will use 4,000 equity at the rate of rupees 10. This is the second plan. And what is the third plan? Third plan is company will use 80% debt and 20% equity. So what is 80% debt? 2 lakh 80%, 1 lakh 60,000 debt plus 20% equity. 20% equity means 40,000 equity, that is equal to 4,000 equity at the rate of rupees 10. So these are three capital structure. The company requires 2 lakh. There are three proposal. First proposal, it will use 20,000 equity shares at the rate of 10. Second proposal, it will use 1 lakh debt, 60,000 preference share and 40,000 equity shares. And plan C, it will use 1 lakh 60,000 debt and 40,000 equity shares. Okay. Now, what the question tells, the company's estimated EBIT is 50,000 annually. The EBIT of the company is 50,000. If the EBIT of the company is 50,000, we have to select which plan is better, whether plan A is better, plan B is better, plan C is better. For this, we will do a EBIT EPS analysis of the business. How EBIT EPS analysis is done? EBIT EPS analysis is done. EBIT EPS analysis, what we have to do? We have to find out EBIT in different plan and we have to find out EPS in different plan. And the plan where EPS is highest, that will be our optimum capital structure or best capital structure. Let's see what is the EBIT. EBIT is given 50,000 in each case. 50,000, 50,000, 50,000. Three plans are there. From EBIT, we have to less interest. When interest will be paid? Interest will be paid when you use debt capital. You look at the plan, in which case you use debt capital. In plan A, you do not use any debt capital, 20,000 equity capital. In plan B, you use debt capital. How much debt capital you use? In plan B, you use 1 lakh debt capital. 1 lakh debt, at how many percent you have taken the debt? It is given in the question 10%. So 1 lakh debt at 10%. What is the interest? 1 lakh into 10%, it is coming 10,000. In plan C, just look at what is the debt portion. The debt portion is how much? The debt portion is in plan C, the debt portion is for 1,60,000. 10% debt. 10% debt means 1,60,000, 10%, you have to pay interest 16,000. So in these two cases, in first case there is no interest, but in second and third case there will be interest. Now what is the EBT? EBT means earning before tax. Earning before tax is coming 50,000 in first case, 40,000 in second case, and 34,000 in third case. Next, we will reduce tax from EBT. That is known as less tax. Suppose tax rate is 50%. If tax rate is 50%, in first case, tax will be 25,000. In second case, tax will be 20,000. In third case, tax will be 17,000. Whatever we get, that is known as earning after tax, or we call it profit after tax, or we call it PAT. We get PAT, profit after tax, or this PAT is also known as net profit. What is net profit we get? Net profit we get in first case 25,000, second case 20,000, third case 17,000. Next we will deduct preference dividend. What is preference dividend? Preference dividend will occur in that plan where you use preference capital. Please look at where you use preference capital and what is the preference dividend. In first plan, you do not use any preference capital. But in plan B, you use preference capital. How much preference capital? 60,000 rupees preference capital. What is the preference dividend rate fixed? The preference dividend rate fixed is 12%. 60,000 into 12%, it coming to 7,200 preference dividend. So please look at this. When PAT is given, out of PAT we deduct preference dividend. In second case, preference dividend comes 7,200. And what is the earning? The earning which is available, that is known as earning available for equity shareholders. In first plan, it is 25. Second plan, 12,800. Third plan in 17,000. Next, we have to find out number of equity shares. Number of equity shares we have to find out in different plans. In first plan, what is the number of equity shares? Just look at plan A, 20,000 equity shares of 10 each. The number of equity shares is 20,000. In plan B, what is the number of equity shares? Number of equity shares is 4,000 equity shares of 10 each. And in plan C, it is 4,000 equity shares of 10 each. So what is the number of equity share? Plan A 20, plan B 4, plan C 4. 20, 4, 4. This is B. Now what we will do? We will divide A by B and we will get earning per share. What is earning per share? How earning per share is computed? A divided by B. Earning available for equity shares divided by number of equity shares. Whatever we get, that is known as earning per share. Earning per share is in first plan 1.2, second plan 3.2, and third plan 4.25. Just look at in which plan EPS is maximum. EPS is maximum in plan C. So plan C is the optimum capital structure. This is the best capital structure. Hence, the company should opt for plan C, because in plan C, the EPS is maximum. This is known as EBIT EPS analysis. So EBIT EPS analysis is the first factor which must be considered while designing an appropriate capital structure or optimum capital structure in an organism. The second factor which we consider while designing optimum capital structure, that is known as cost of capital. What is cost of capital? We know that cost of capital is the minimum expectation of the provider of capital. The person who provide capital to business, they expect something. The minimum expected rate is known as cost of capital. The minimum expectation of debenture holders or debt holders is known as cost of debt, and the minimum expectation of equity holders are known as cost of equity. We know that cost of debt is less than cost of equity because equity shareholders take higher level of risk than debt holders. Hence, they expect more than the debt holders. Hence, the cost of debt is less than cost of equity. We know KD is less than KE because of two things. First, the risk is less. In case of debt, risk is less, and in case of debt, the interest is tax deductible. These are the two reasons because of which cost of debt is less than cost of equity. But hence, you can tell that a person should use more and more debt capital. But please see, once a company start increasing its debt capital beyond a particular limit, the risk of equity shareholders increases. The risk of debt holders, existing debt holder increases. Hence, the cost of equity also increases with increase in debt portion of a company beyond a particular level. Hence, once you use more and more financial leverage, once you use debt capital more and more, what happens? The cost of equity also increases. Cost of equity increases. Cost of equity increases. Hence, the overall cost of capital, which is known as KO, that is the weighted average cost of capital, that increases. So how weighted average cost of capital is calculated? Weighted average cost of capital is calculated by taking weight of first source into cost of first source, or weight of debt into cost of debt plus weight of equity into cost of equity. This is the formula to calculate weighted average cost of capital, or KO, or overall cost of capital. So this is the formula of overall cost of capital. And while designing cost of capital, we should know that we should design that capital structure where overall cost of capital is minimum. So what is best capital structure or optimum capital structure? Optimum capital structure is that capital structure where overall cost of capital or weighted average cost of capital is minimum. So we have to find out the weighted average capital structure or weighted average cost of capital, WACC, in different capital structure, and in that capital structure where KO is minimum, that capital structure is known as optimum capital structure or best capital structure. We will discuss this with the help of one example and it will be clear. Illustration number 10.2. What is 10.2? A company is planning for an appropriate capital structure. Company is deciding capital structure, appropriate capital structure. The cost of debt after tax and cost of equity at various levels of debt equity mix are given. What is given? Debt as a percentage of capital employed. So this is percentage of debt. If you use 0% debt, what is the cost of debt? What is the cost of equity? If you use 20% debt, what is the cost of debt? What is the cost of equity? If you use 40% debt, what is the cost of debt and what is the cost of equity? If you use 50% debt, what is the cost of debt and what is the cost of equity? And if you use 60% debt, what is the cost of debt and what is the cost of equity? You see that when you increase debt capital beyond a certain level, cost of debt KD also increases. Similarly, KE remains constant up to a particular level of leverage. After that, KE also increases. So out of these 5 capital structures, 5 or 6 capital structure, which one is best capital structure? Which one is optimum capital structure? We have to find out. What is our discussion? We have to select that optimal mix of debt and equity where the weighted average cost of capital will be minimum. What is best capital structure? Best capital structure is that capital structure where WACC is minimum. Okay, now we will find out cost of debt is given, cost of equity is given, then we have to use this. This is cost of debt, this is cost of equity, this is percentage of debt, this is percentage of equity. So first we have to calculate cost of debt, KD is given, cost of equity is given, percentage of debt is given, percentage of equity is given. First is cost of debt, cost of equity and percentage of debt, percentage of equity. Please just see, if you use 0% debt, then you have to use 100% equity. If you use 20% debt, 0.2, you have to use 80% equity. If you use 40% debt, you have to use 60% equity. If you use 50% debt, you have to use 50% equity. If you use 60% debt, you have to use 40% equity. So this is percentage of debt, this is WD, and this is percentage of equity, WE. We know that what is weighted average cost of capital, WACC is equal to KD into WD plus KE into WE. We have to apply this formula and find out weighted average cost of capital. KD, this one, into WD, this one. We have to multiply. And we have to multiply the other two KE with this one. Star star multiply होगा और टिक टिक multiply होगा और दोनों ऐड हो जाएंगे. So in the first case, KD is 10% and percentage is 0. So what is the case? KDWT is equal to 0. And in the first case, KE is 15%, percentage is 1. WE is 1. That is 15 into 1. 15 into 1, it is coming to 15%. So 0 plus 15%, it is coming 15%. In the second case, where you use 20% debt and cost is 10%, 10 into 0.2, that is equal to 2, and another is 15 into 0.8, that is equal to 12, and it is coming to 14. And in the third case, if you use 40% debt, what will happen? 12 into 40%, that is equal to 4.8, plus 16 into 6%, that is 9.6. If you add this, you will get 14.5. In the fourth case, if you use 50% debt and the cost will be 0.5 into 13, that is 6.5. Another is 0.5 into 18, that is equal to 9. And it we will getting 15.5%, that is weighted average cost of capital or WACC. Next, in the next case, if you use 60% debt and you will get 60% into 14, that is 8.4, plus 40% into 20, that is equal to 8, 16.4. Now please look at this in the WACC figure. In case of WACC, please tell in which case the WACC is minimum. The WACC is minimum if we use first case it is 15, next is 14, next is 14.4, next is 15.5, next is 16.4, and in second case it is minimum. Second case means the company should use, here it is minimum. In the second case it is minimum, it is coming 14%. So what is the best capital structure? The best capital structure or optimum capital structure is where the company is use how many percent debt? 20% debt. And how many percent equity? 80% equity. 20% debt plus 80% equity is the best or optimum capital structure in this particular case. 20% debt and 80% equity. 20% debt and 80% equity is the best capital structure. So what is the best capital structure? 20% debt and 80% equity. So we are discussing what are the factors which must be considered while calculating the capital structure, while designing the capital structure of an organization. We have discussed two important factors. First factor is we will make a EBIT EPS analysis of a different capital structure, and we have to select that capital structure where EPS is maximum. Second point, we have to find out the optimum capital structure, or we have to find out the weighted average cost of capital in all capital structure, and the capital structure which provide minimum WACC or minimum weighted average cost of capital or minimum composite cost of capital or minimum overall cost of capital. That cost of capital, that capital structure is best. Next we will discuss what are the other factors which are considered while designing the capital structure of an organism. Next one is cash flow. The company has to analyze its cash flow pattern, how cash is coming into the business. If there is a steady cash flow in your business, that means you are in a better position to solve the debt. That means you are in a better position to pay the interest and principal EMI. You are in a better position. Hence, that company where the cash flow are stagnant, consistent, cash flow are less fluctuative, in that case, companies should use more and more debt capital. Why companies should use more and more debt capital? That means in that case, the company is in a position to solve the debt better. So if the cash flow pattern of your business is constant, stagnant, consistent, predictable, you must use more and more debt capital. But if the cash flow of your business is fluctuative in nature, unpredictable in nature, then you should not use more and more debt capital, because there is a risk of non-payment of debt service. There is a risk that you cannot pay the interest and principal in due time. Hence, the cash flow pattern decides the capital structure of the organization. But if the companies anticipate that there is consistent cash inflow, then it must use a more lot of debt in their capital structure. And if it is not possible, if the cash flows are variable, unpredictable, it is dangerous to use more debt capital. In that case, you should use more and more equity capital. So 3 points we have discussed for designing capital structure. First, we have discussed EBIT EPS analysis. Next, we have discussed computation of weighted average cost of capital. Next, discuss cash flow pattern of the organization. Next point, which we consider while designing the capital structure of the organization, is control. What is control? There are two types of companies. One is closely held company. What is closely held company? In case of closely held company, the family run company, the number of shareholders is very less. That is known as closely held company. It is owned, the shareholders and the business is owned by few family members. If that company issue equity capital, new members will come and their control will be diluted. That means if there is a closely held company, generally family members do not want to dilute their control. Hence, in that company, generally go for more and more debt capital. It issues less and less equity capital. So in case of closely held corporations, what is closely held corporation? That is in case of family run business, they use more and more which capital? Debt capital to retain the control. They use less equity capital and more debt capital, because if they will use more equity capital, there is a fear of losing control. Hence, they do not use more equity capital. Closely held company use closely held company use more debt capital and less equity capital. The reverse is true in case of widely held company. What is widely held company? In case of widely held company, shareholders are many. The company is not in control of a particular type of shareholders. It's not a family run business. Normally, private companies are closely held and public companies are widely held. Normally. But closely held company are those companies where number of shareholders are few, and widely held company are those companies where number of shareholders are large. Hence, in case of widely held company, they use more equity capital and they use less debt capital. Because losing control is not an issue in case of widely held company, because there are already many shareholders. If few more will be added, does not affect the mindset of the existing shareholders. But in case of closely held company, there are very few shareholders, and if new members come, they generally do not feel better. In that case, generally the closely held company use more debt capital and less equity capital, and a widely held company use more equity capital and less debt capital. This is the case of control in case of designing capital structure. Next one is another point which we have to consider while designing capital structure, that is flexibility. What is flexibility? Flexibility means the capacity to expand the capital structure or contract the capital structure when you require. So if the company capital structure must be designed in such a way that it may be expanded or it may be contrasted according to the changing business situation. If you can able to expand or contract your capital structure as per your changing business situation, it brings flexibility to your capital structure. Next point which we consider, that is known as size of the company. Generally, on the basis of size of the company may be small company or large company. Generally, small company do not have reputation. They do not have reputation. So if they approach the bank for finance, very few bank will give them finance. So small company largely depend upon own capital. They depend upon equity capital and retained earning. So small company use more equity capital or more own capital. But in case of large company, they have a credit history. People have faith on large company. Finance company have faith on large company. Banks and financial institutions have faith on large company. Hence, large corporations generally use more debt capital. So we have covered size of the company affect the capital structure. So what is the size of the company? Small companies rely on own capital and retained earning, and large company depends upon loan capital for their designing their capital structure. A large corporation depends upon more loan capital, but a small corporation depends upon more loan capital, more own capital. Next, we'll discuss marketability of the security. What is marketability? Marketability means ability to sell in a time frame, that is known as marketability. So you know that in the business, situations are not stagnant. There may be recession phase, there may be boom phase in a economy. During recession phase, the stock market generally downs. In that case, if you will issue equity share, nobody will buy your share. So during the time of depression, during the time of recession, companies usually use debt capital. But during the time of boom, what is boom? Where there is much more stock market activity, people are interested in investing in stock market, then in that case, what happens? Companies use more and more equity capital. So what is on the basis of, this is on the basis of marketability we have discussed. During which phase? During recession, companies use more which capital? During recession, companies use more debt capital, use more debt capital. And during boom, during prosperity, or boom, companies use more equity capital, use more equity capital. The next point we will discuss flotation cost. Now, what is flotation cost? Another factor which we must consider while designing capital structure is the flotation cost. Flotation cost means issue expenses. We know that the issue expenses of debt is less than issue expenses of equity. Though issue expenses is a small fraction of the capital, but in case of small companies, issue expenses matters. In case of small company, if issue expenses is more, then they go for more and more debt capital. And if issue expenses is less, they go for equity capital. So issue expenses or flotation cost also affect the capital structure of the company. So we will summarize our discussion today. So in today's class, we have discussed what is capital structure. We know that the capital structure tells us regarding the composition of capital. It tells us regarding mix of long-term source of capital. We know that there are two types of long-term source. One is ownership capital, another is creditorship capital. Ownership capital is known as equity and creditorship capital is known as debt. And the company has to make a composition of debt and equity. That composition in which the combination or composition is best is known as optimum capital structure or appropriate capital structure. Appropriate capital structure depends upon many factors. What are the factors? While designing appropriate capital structure, we have to make EBIT, EPS analysis. We have to make the cost of capital analysis or weighted average cost of capital analysis, and we have also some other factors which decides the appropriate capital structure. Those factors are suitability, risk, income, control, timing. These are also affect the debt equity mix of an organization. Next, we have discussed different keywords of our discussion. One is capital structure. What is capital structure? We have discussed capital structure is the mix of long-term sources. Different type of long-term source of finance which are used in the business is known as capital structure. It's the composition of debenture, bond, loan taken from financial institution, preference share, equity share. It's known as capital structure. And capital structure is also called financial structure. Next, we have discussed cost of capital. What is cost of capital? Cost of capital is also known as WACC or weighted average cost of capital or overall cost of capital or composite cost of capital. What is called overall cost of capital or composite cost of capital? It is the weighted average of various sources of capital. Next, we have discussed financial leverage, which is also known as trading on equity. What is trading on equity? This is one important question. Trading on equity is a type of financial planning where we use low cost debt capital to magnify the return of the equity shareholders or to increase the EPS of the organization. And this happens only when the company can generate an income more than the cost of debt, that is known as financial leverage or trading on equity. So next we will discuss different important questions relating to today's class. First question is, what are the features of appropriate capital structure? An appropriate capital structure is one where WACC is minimum, and an appropriate capital structure is one where EPS is maximum. Then another question is, discuss the determinants of capital structure. What are the factors affecting capital structure? One is EBIT, EPS, then suitability, timing. Then we have discussed other factors, that is flotation cost. These are different determinants or factors affecting capital structure. Next, how you design the capital structure of a company. Next important question is, under what conditions different type of securities would be issued, and what is the suitability of debt capital and equity capital. And some question is there, short note, that is trading on equity, it is an important question. Cost of capital, it is an important question. Flexibility in capital structure, widely held company, closely held company, we have discussed all these things. And there is a problem also on calculation of optimum capital structure. You will try it at home. You have to decide that capital structure where WACC is minimum or weighted average cost of capital is minimum, that is the optimum capital structure. So with this, I conclude my session today. Thank you. Thank you for attending my class. Thank you. Thank you very much.